Okay, Dad loves you finance. Today we're going to talk about investment banks, fund managers, and brokers, aka finance advisors. We're going to get to stock picking soon, which is what you should mainly be spending your time on doing. However, first, some lessons I've learned about finance advisors. You should always see how these advisors will make their money from you. Almost always their interests will not be aligned to yours. Investment bankers get their money if the deal goes through, which means their spreadsheet calculations and their advice will almost always be yes, do the merger or acquisition. Let me see. Whether or not that merger or acquisition will make you profit, they'll say yes, do it. So beware investing in any company which has just taken advice from an investment bank to do a merger or acquisition. Don't invest in investment banks as they always take their profit out in bonuses for themselves. Side note, don't invest in any airlines or any company that requires high capital expenditure just to keep their assets current. Telecommunications companies at the moment, we have 5G coming, but we've already had 3G and 4G, so probably 6G is going to be on the way. Okay, back to it. Fund managers take a management fee and maybe a performance fee. But since most fund managers find it very hard to outperform an index fund after their fees, you should always just invest in an index fund with the lowest fees. Because the fee is a certainty, but performance is uncertain. I just read an article that said in Australia, out of all equity funds, 70% underperformed the S&P ASX over 5 years. Brokers make money when you buy and sell shares, but the best way to make long-term money is to avoid all these frictional costs and buy and hold long-term. These frictional costs are also another reason why fund managers who think they know best buy and sell more than they need to and increase the fund's costs. Remember, costs are certainty, performance is uncertain. You too should place yourself under measurement and see if you outperform an index fund post fees over a 5 to 10 year period. If you don't outperform, then stop picking stocks and allocate the majority of the money to an index fund with low fees. You can still do it to keep informed, but there's still plenty to do in asset allocation to diversify into property or other assets or Hermes bags, according to your mom. And also, your income as an actor or a chef or sports or accountant or director or doctor or whatever profession that you end up choosing to do. Okay, also, educate yourself and read books like... Oh, where is it? There we go. Like this one, for example, Stocks for the Long Run by Jeremy Siegel. That is stocks, bonds, gold, inflation from 1800 to 1990. Let me see. But if you don't want to read the whole book, just read the last chapter, chapter 20. Now, read about Warren Buffett, but beware anybody who drops his name as their investing strategy. It's very easy to talk about Warren Buffett. It's very hard to do what he does. Basically, it comes down to this. Beware of all finance advisors of any type. Listen to all of them, but none of them are worth paying for their advice, whether it be in management fees or performance fees or broking fees, so long as you did what I told you before and studied accounting. Study accounting! But if you don't, put the majority of your money into low-cost index funds, mainly US and China and Australia, and the rest in multiple countries, with no currency hedging. You want the diversification and smaller fees because of no currency hedging. that loves you.